Welcome back. Time for us to learn about debits and credits and double entry accounting as we prepare to record transactions in the accounting records. It is important to remember from Chapter 1 how each account affects equity. Revenues increase the equity side of the equation, and expenses decrease equity. And of course, the payment of dividends to shareholders reduces equity. The purpose of a clear understanding of the accounting equation is to help you begin the thinking process of how transactions affect the accounting equation, then translating and writing each transaction into the journal in accounting language. The ledger is a collection of all accounts in an information system. A company's size and diversity of operations affect the number of accounts needed. A chart of accounts is a listing of all accounts in the ledger. Notice that each account includes an identifying number. For example, cash is the first account and is numbered 101. Companies assign a number to each account to facilitate ease of coding and locating the account. The order of the list helps accountants to locate account names when they are looking at the list. Notice that accounts are grouped together by number ranges. For example, asset accounts begin with an account number of 1, all liabilities with 2, equity accounts with 3, revenues with 4, and expenses with 6. This is a common numbering scheme, but some companies will use a far greater range of numbers because they have many more accounts. Let's move on to the most important part of the accounting language now. That would be double entry accounting and debits and credits. Writing the information in the journal is an entry point of the formal accounting system. To do this, we need to make sure we have a clear understanding of a few more definitions. First, accountants often use a tool called the T account to represent a general ledger account. It's a quick way to analyze transactions before we enter the information in the journal. But it is not a formal part of any accounting system. It does help us illustrate easily how transactions affect accounts. We start by writing the account title on the top of the T account. The left side of a T account is always called the debit side, and the right side is always called the credit side. This terminology comes from 18th century English bookkeeping where the words debitor and creditor were used. We still use the terms today. The words do not have any significant meaning other than they stand for the left and the right side of a ledger. Sometimes debit is abbreviated DR and credit is abbreviated CR. To enter an amount on the left side of an account is to debit the account. To enter an amount on the right side of an account is to credit the account. Debits on the left, credits on the right. When the sum of the debits exceeds the sum of the credits in a particular account, the account has a debit balance. Whether a debit increases or decreases an account depends on what kind of account it is. You can see I've written the accounting equation on top of the T account. In short, each account type increases on the same side as it appears over the T account in the accounting equation. A warning: be careful about equity accounts. Common stock and revenues follow the general pattern. They are both credited when they increase. But because expenses and dividends reduce stockholders' equity, they behave just the opposite. They increase with debits and not credits. More on this in a couple minutes. Before we go any further, we need to define how transactions are reflected in the accounting records. Double entry accounting was invented way back in the 15th century by a powerful Italian banking family named the Medici. Obviously, the system they developed works very well since we still use it today. Double entry accounting requires that the accounting equation remain in balance at all times, always. Therefore, For each transaction, there are two rules. First, at least two accounts are involved. One account has a debit and the other account will have a credit. And two, total debits must equal total credits. Please review this concept in your textbook. Now this is where things get a little tricky. You're going to need to memorize the rules of debits and credits, just like you memorize the alphabet, or how to spell your name, or how to add 2 plus 2. But once you learn debits and credits, the language of accounting starts to make sense. So please invest your time on this subject. It will pay off for you later. Because assets are on the left-hand side of the accounting equation, to increase an asset, we will debit it on the left side of the T account. Try to memorize what happens for the cash account. If you can remember what happens to the cash account, often you can figure out what would happen to the other accounts. Because cash is an asset, it increases with a debit and decreases with a credit. Its normal balance is also a debit. You would expect the cash account to have a debit balance. All asset accounts work the same way. Equipment, accounts receivable, supplies, inventory, etc. Taking the next logical step, liability accounts are on the right hand of the accounting equation. Therefore, they behave exactly opposite the way assets do. Liabilities increase on the credit or the right side of the T account, and the normal balance is also on the right side. Equity behaves the same way generally. If you can remember what to do to increase an account, to decrease it, you will do just the opposite. Memorize the accounting equation and these rules by doing the homework and drilling yourself. To help you remember the rules of debits and credits, I've posted a short YouTube video in D2L. Let me know what you think. It's a little corny, but it's fun. And you'll never forget debits and credits after watching it. Because equity is a little more complicated, we will review the rules of debits and credits using the expanded accounting equation to explain how equity accounts behave. With equity, it's always helped me to remember that common stock and revenue behave just like you'd expect them to. Because equity is on the right side of the accounting equation, it increases with credits. Common stock and revenue increase equity, so they also increase with credits. Remember that dividends and expenses do just the opposite. They reduce equity. Because they have the opposite sign as common stock and revenue, they increase with debits, and their normal balance is on the debit side. We determined the balance in the accounts in the last chapter, but in this chapter we will look at a more comprehensive way to determine an account balance. Let's have a last look at our favorite T account. The cash account is an asset, so it increases, or receipts are shown on the debit or left side, and decreases or payments are shown on the credit or the right side. To determine if an account has a debit or a credit balance, we total the right and left sides and place the balance on the larger side. Notice that the sides are not always labeled debit or credit. That is because as an accountant, you are expected to know that the left side is a debit and the right side is a credit. In this example, our increases in cash amount to $36,100 and the decreases total $31,300, so the cash has a debit or a positive balance of $4,800. It may help in the beginning to memorize which accounts increase with a debit. I already suggested remembering that the cash account increases with a debit, and therefore all assets do. Here's a memorization technique to help you. ADE is an abbreviation to help you remember that assets, dividends, and expenses increase with debits. LRC is an abbreviation to help you remember that liabilities, revenues, and common stock increase with credits. I like to remember it by picturing getting help in the accounting lab located in the Learning Resource Center at CRC. Take a break before you head into part 3. See you shortly.